Welcome to Mind Your Money. I'm Brooke DiPalma, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, we get you ready to wrap up 2025 on a high note so that you could start 2026 with your best foot forward. First, we explain the big changes that could be coming to your taxes next year thanks to the One Big Beautiful Bill. Plus, an expert lays out 5 year-end tax planning actions to do in order to minimize the tax hit on your investments. And Vivian, too, aka your rich BFF, on social media shares her personal finance year-end checklist later in the show. You don't want to miss it. It's been a volatile year in the markets. Some trades worked, others maybe not so much. Now's a good time to see if you can use those losses to your advantage at tax time. It's called tax loss harvesting, and here's how it works. Say you bought 1,000 shares at $50 and sold at $60. That's a $10,000 capital gain. Then another investment, well, it dropped. You bought 1,000 shares at $50 and the stock price fell to $37. If you sell, you can lock in a $13,000 capital loss. You could use that loss to offset your gain dollar for dollar. So a $13,000 loss cancels out a $10,000 gain, meaning no capital gains tax. And you can carry leftover losses forward, plus deduct up to $3,000 a year against income. But watch the wash sale rule. If you sell a stock for a loss and buy the same or quote unquote substantially identical one within 30 days, you can't claim that same loss. Now, Fidelity says one workaround is switching from an individual stock to an ETF or a mutual fund in the same industry. But cryptocurrency, well, that's different. Crypto doesn't have the wash sale restrictions. You could sell at a loss and buy back immediately. But don't wait to harvest losses this year. Traders must settle before the final market close. That's at 4 p.m. Eastern on December 31st. The One Big Beautiful Bill Act brought changes to tax implications. Let's break down what you need to be thinking about ahead of tax season. Ben Werschel joins us now. Ben, one of those changes was Trump accounts. It's a new type of savings account for children, and those born between 2025 to 2028, they'll actually get $1,000 of seed money. Break down how this works and what this means for tax purposes.
Yeah, Brooke. So these accounts won't formally be online until July of next year, but there will be a way to sign up for them during this coming tax season. It's an new IRS form 4547, where you sign up your children, and there's a little checkbox to attest whether or not they were born after 2025 if you want this, what's being called a pilot program. We also had news this week that Michael Dell and his wife are donating $6.25 billion to expand the program to children 10 and younger born prior to 2025. No formal guidance yet on how to sign up for those, but the Trump administration is promising a whole portal by the time these are online next year. Another thing to watch here for these accounts is if you're employed, what your employer is going to do here. There's a full court press underway from the Trump administration to have as many companies as they can sign up to help. An employer can add $2,500 each year to these accounts. So that could be another significant perk if your company decides to sign up for that. When it comes to personally contributing, you can add even more on top of this free money that's kind of a no-brainer from the government or possibly from your employer. That's where it gets a little bit more complicated. It depends at the end of the day what you want to use this money for. A lot of tax experts note that money that goes into this account personally is post-tax, and then you pay taxes on the other end. So if you're looking to just fund your children's education, you might want to look at other options like a 529 account, which has a few more tax advantages there.
Now, Ben, something that Trump had campaigned on was the no tax on tips, overtime, Social Security, or on auto loans as well. Now, many of these provisions, they are in effect until 2028, until the end of his term. But what do Americans need to know to take advantage of those?
Yeah, so these are the big 4 Trump campaign promises that are now the law, and they all apply to the 2025 tax season. There are deductions for up to $25,000 on tips, up to $12,000 and $12,500 per person on overtime, a new tax deduction for seniors. This is in lieu of a no tax on Social Security. It's meant to offset that. And there's up to $10,000 annually for your interest on your auto loans. That up to is really important for people to pay attention to because there's a lot of fine print in in here, income limits, all these different factors that will really determine how much each individual gets to benefit from there. One good example here is there was a last minute revision on Capitol Hill to include gig workers in the tips provisions. That was added to the last minute, but exactly how it works is still being worked out. So it's going to require a lot of advanced planning for folks if you think you're going to qualify for this, to figure out exactly what the restrictions are and how you sign up once it comes to tax season, because all of these four also show up differently in the tax code. Some are kind of more akin to the mortgage interest deduction, some just straight off your income. So it's going to be a kind of complex season, but these are four significant goodies that the Trump administration put into effect.
Ben, definitely lots of implications. Definitely time to start planning right now. And also the big beautiful bill, it also addressed individual rates and the increase in SALT deduction limit. How do we expect that to change the filing season? And are there things that taxpayers can do right now?
For sure. Yeah, the individual rate part of this is kind of the easier part, even though this was the centerpiece of the bill. The whole reason that Washington was focused on this bill this year was to keep individual rates at the same amount. They were lower rates were scheduled to expire and go up next year if this bill hadn't passed. So the bill did pass, so rates are staying exactly the same. So that actually will be a little bit easier in tax filing season with rates staying the same way they are. The SALT state and local tax deduction will be changing in the upwards direction. It's going from $10,000 a year to $40,000 a year in terms of what you can deduct from your federal taxes from your state taxes. The advanced planning that needs to be done there is really to figure out your state tax situation, because that's the key factor here. But this is a provision that at the end of the day is really expected to help a lot of high-income taxpayers in high-tax states, New York, New Jersey, Massachusetts, California, places like that. So they're really looking towards this as a major provision. The overall takeaway here from the Trump administration is that all these different goodies could end up in a lot bigger refunds, pleasantly for people than they got in previous years. All of these, if you're able to take advantage of even a couple of these, you're looking at a bigger tax, less of a tax burden in the coming year. Between now and then, though, what accountants will tell you is there's going to be a lot more paperwork. Reuters estimated that the tax code is 10 to 15% more complex this year than it was last year. And I don't think anyone would call the tax code simple before. So this is going to require a lot of planning, as you mentioned, starting now, even though April 15th is quite a ways away.
So Ben, lots of paperwork could eventually lead to bigger returns. We'll keep our fingers crossed for that.
Right.
Ben Werschkel, thank you so much for joining. About 140 million Americans filed their taxes for the past year, receiving roughly $253 billion in their returns, a year-over-year increase of about 3%. And while you still have several months to prepare and file your 2025 taxes, now's the time to make some key changes in order to ensure the filing process goes smoothly and even lower your tax burden too. Here with us is Adam Lundman. He's JP Morgan's Private Bank's head of tax strategy. Adam, you have several actions that taxpayers can take. Where exactly should they start?
Yeah, the best place to start is to get an understanding of where you stand for the year. And that really involves getting a sense of income, losses, deductions, and gains that you've recognized throughout the year. And with that, an understanding and estimate of your 2025 tax liability, you can start to take actions to really plan to mitigate that liability before the end of the year. And so with a few weeks left in the year, it's not too late to reach out to your accountant, have that conversation with them, get a sense of where you are, and then you can work with them on any tax-related moves that you want to do before the end of the year.
We did mention tax loss harvesting. We explained it a bit. Why is that so key here?
Yeah, it's really critical, and it's always a topic of conversation at year end because especially in a year where there's been some positive market performance, many have taken gains off the table, taxpayers can sell securities at a loss and offset some of the capital gains that they've realized so far. I think, we tend to talk about it at year end, but it's also something people think about doing systematically throughout the year, even in a year with positive market performance where there has been some dispersion in areas of the market where there's opportunities to take advantage. And the one thing you want to watch out for when people do sell at a loss, they want to typically reinvest in something else. You have to be careful of the watch sale rule, which could disallow the loss if you sell a stock at a loss and then within 30 days on either side of that trade date, acquire the same or substantially identical securities.
Now 2025, it's been a hard year, but perhaps some people were able to be a little bit generous. What about charitable deductions?
Charitable deductions are especially topical this year, and that's because for high-income taxpayers who itemize, there were some changes in the tax legislation that was enacted earlier this year that is actually going to impose some haircuts on charitable giving starting in 2026. So if you're a high-income taxpayer who itemizes, there are in 2026 a new 0.5% floor on charitable deductions, which will disallow the first 0.5% of your adjusted gross income starting next year. And for itemizers, there's a new roughly 5% reduction on itemized deductions, such as charitable contributions. And so for that reason, a lot of people are talking about front-loading charitable contributions in 2025, because all things being equal, a charitable contribution in 2025 could be more valuable than a charitable deduction in 2026. But for non-itemizers, there's also a new change going into effect next year that is going to allow a deduction for charitable contributions up to $1,000 for single filers, $2,000 for married filing jointly, effective next year. So definitely some things to think about in your charitable planning as we go into year end.
And so important to keep track throughout the year as we make our way into next year, perhaps thinking ahead. But when it comes to retirement savings, how can both younger workers as well as retirees sort of think about this and make sure they're ultimately prepared?
Yeah, so retirement accounts are an opportunity to take advantage of tax deferred growth.
Yeah.
And
how young are we thinking?
Yeah, well, once you start working, it's a good idea, if you can afford to do it, to contribute to retirement accounts, right? So at the end of the year, it's a good idea for people to think about topping up their retirement contributions, really taking advantage of the maximum amount allowed and benefiting from that tax deferred growth over time. So contributing as much as you can to the extent you have the ability to do so is typically a good tax idea.
So ultimately try to get as much money in those accounts as you can before December 31st.
Right.
Adam Ledman, thank you so much. He's JP Morgan. Thank you so much for joining us. Appreciate your time. Lots more personal finance tips and tricks ahead, plus our weekly segment, Ask Yahoo Finance Anything, after the break on Mind Your Money. As 2025 winds down, it's time to get your financial foundation intact. So what should be on your year-end checklist to help kick off 2026 on the right foot? Our next guest has the tips that you need to know. Joining us now is Vivian Tu, aka your rich BFF. She also serves as SoFi's Chief of Financial Empowerment. Vivian, you often refer to the STRIP method. Can you give us an example of how people could start using that right now?
Yeah, I always jokingly say when my friends ask, if you want to be rich, you need to strip. S stands for savings. I usually recommend 3 to 6 months of living expenses, 6 to 12 if you're a head of household, into a high yield savings account so that you can be earning more interest. T then stands for total debt. You're going to rank your debt from highest to lowest interest rate, make the minimum payment across everything, and then any additional debt pay down funds you would put towards the debt with the highest interest rate. R, retirement, everybody's favorite word, taking advantage of tax-advantaged accounts like a 401k or 403b through your work, as well as a Roth IRA or a traditional IRA individually. These are just great ways to get those little nuggets of candy from the government. We all love a tax benefit. And then inside of those accounts, we want to invest. I really recommend that folks don't try to cherry pick single stocks because more often than not, it exposes them to way too much company risk. Whereas I prefer investing in larger baskets of index funds that really allow you to just participate in any sort of upwards market momentum. And then last but not least, P, you got to make a plan. You do not get to have happily ever after if you don't know what that looks like. So I really encourage people to use this time to also really goal set.
Let's break that all down piece by piece. First of all, as we make our way towards this new year, we really want to create this sort of financial routine, and those were all wonderful. But how do you jump in and sort of find maybe a high yield savings account that works for you if this is your first time trying to do that?
Yeah, absolutely. Listen, I think it's so important that you get a high yield savings account. So I don't want you to get paralysis by analysis. I will say, you mentioned earlier, I am the Chief of Financial Empowerment at SoFi, and I'm a huge fan of their high yield savings account product, mostly because it's not just a high yield savings account. They also have a high yield checking account. So even money that is sitting aside waiting for your Wi-Fi bill or your groceries can actually continue to be earning you money. We just want to make sure that, especially now as our wallets are feeling tighter and tighter around the holidays, as we're spending, that it's earning us just as much money as, we are working hard for it.
Vivian, some Americans might be watching this right now and they hear savings and they wish that they could save, but they're just in so much debt, maybe even credit card debt. Where do you even begin to pare that back ahead of year end?
Yeah, so credit card debt specifically is the fastest growing, scariest debt because the APR every single year is so high. The average credit card is charging you 20 to 30% interest every single year. So what I really encourage people who are feeling so overwhelmed that they can't get out of this debt is to look into some alternative pay down options, things like personal loans. SoFi offers a great personal loan where you can essentially get that lump sum from them, you pay down your credit cards, and then you're actually able to pay back that loan with them as well.
Vivian, this year we also saw the return of student loan repayments, maybe even for Gen Z. It was their first time having to repay these student loans. What's your recommendation, and what sort of changes can we expect in just a few weeks?
Yeah, I mean, listen, there are going to be even more federal student loan changes expected next year. I feel like right now we're seeing a different headline come out every couple days. So while I don't have a crystal ball exactly, it is a really good time to revisit your student loan payments. Make sure that you are feeling confident about being able to make them on time. If not, looking into what sort of relief programs are available to you, whether that be income-driven repayment, perhaps looking at refinancing your student loan if you feel like your interest rate is just too high. And there's so many different strategies to use, but the first thing to do is to make sure that you're not sticking your head in the sand and avoiding it entirely.
Avoidance is definitely what not to do. But we also did hear from Challenger Gray and Christmas, and they had a pretty staggering number. So far this year to date until November, there have been 1.1 million layoffs. And it's a really tough pill to swallow, a tough pill to even read that, especially around the holidays. For those who have been impacted by these layoffs this year, what would you recommend that they should be thinking about here?
Yeah, I think it's really all about using your network right now. You've heard the phrase that your network is your net worth. It's never been more true. I think a lot of people are actually just going online and trying to apply for jobs, but I think that's the wrong approach. I would actually reach out to your personal network and struggle in public. Say that I've been laid off. Say that you're looking for work. Say that what you're open to. You would be so shocked how many people will come out of the woodwork and say, oh, well, my company's hiring for this, or I know somebody who could potentially get you a job here. When you utilize that network, it essentially puts your resume on a short stack versus the overall general pool. And this means that you're likely just going to have a little bit of an easier time getting your foot in the door that very first opportunity. And that's always the hardest part.
Vivian, too, aka your rich BFF, such great tips. Thank you so much for joining us, and happy holidays.
Thank you so much for having me.
With the holidays fast approaching, and for those with their wallets in a bind, the gift of money might be better than any other. But what if you could give cash while making it thoughtful and maybe as interesting as the Nintendo Switch 2? Let's dive into creative ways to give money as a gift. Yahoo Finance's Casey Bond joins us now. Casey, let's start with one of the more long-term benefits, and that's sort of a CD could be an option. For those who have never heard of a CD account, can you explain what it is?
Sure. Well, a certificate of deposit, or CD, is a type of account that allows you to deposit a lump sum, and then over the term length, you earn a guaranteed interest rate. So terms can range from just a couple of months to several years. But it's important to point out that in exchange for that guaranteed rate, you're expected to keep the money on deposit for the entire time. Otherwise, you could pay an early withdrawal penalty. But these accounts are really beneficial, particularly in a time like now when interest rates are falling. So, if savings accounts or other investments or deposit accounts are going down, your CD is going to continue to earn that competitive rate.
Casey, we've seen a lot of people turn to CDs this past year, but how can you go about gifting a certificate of deposit this holiday season?
Yeah, well, unfortunately, you can't gift a certificate of deposit to another adult, but you can give one to a child by opening a custodial account and naming them as the beneficiary. So you'll need a few details like their name, address, social security number. And then when they reach a certain age, which is typically around 18 to 21 years old, they gain access to those funds. So it's a really great way to start early, teaching your kids about the value of saving money, how compound interest works, and just introducing them to banking and savings.
Casey, let's go old school for a second, because for those who are looking instead just to give hard cash that someone can use right away, what are some creative ways to go about doing that?
Yeah, well, speaking of old school, another great gift, especially for kids, is a piggy bank. It's, a combination of teaching your kids about saving money and also giving them kind of a toy. So you could fill the piggy bank with some cash or even gift cards, and give that to them as a fun gift. Another kind of creative, maybe a little bit silly option is gifting Play-Doh. So taking Play-Doh and replacing the contents with actual money, you can wrap it up in some gift wrap, and then you can say, hey, I'm giving you some dough for Christmas. Another option that is really has some wow factor to it is a money cake. So you bake a cake or even buy one, and then you build in cash in these like plastic sleeves so that the recipient can actually pull this cash out of the cake. It's very dramatic, but they sell these cash stuffing kits online, and there are plenty of tutorials, so it's not as intimidating as it sounds. If you want to go for something a little bit more festive, a money wreath is a great option. You can make a wreath using actual bills and then incorporate things like florals, tinsel, just make a really beautiful piece that the recipient can actually then spend later. And then another option that's really popular, especially around graduation time, actually, are money leis. So lei is, a Polynesian symbol of love and friendship. So you can actually make one yourself pretty easily by stringing cash around, some sort of string. But if you don't feel like going through the trouble, you can also buy one. We recommend just, to show respect to that culture, to buy from a Hawaiian or a Polynesian seller.
Casey, these are all such great tips. I mean, a piggy bank, a wreath, and even a leg. Casey Bond, thank you so much for joining us. I appreciate your time.
Yeah, thank you.
It's time now for Ask Yahoo Finance Anything, where we answer your finance questions. And Ali Canal joins us now with some year-end investing questions from social media. Ali, first question, why do stocks rise when economic data is showing some signs of weakness?
Hey, Brooke, and I love this question, and it's because markets, they don't always trade when it comes to the data, the numbers in front of them. They trade on expectations. So if weak data suggests that the Fed could cut rates sooner, what does that mean? It means borrowing costs are going to get cheaper. It means financial conditions are going to ease. Asset prices are going to rise. So that's why you can get bad news for the economy that sometimes is good news for the stock market. That's not always the case, but we tend to see that when investors are really focused on the policy aspect, aka what the Fed is going to do with interest rates.
And next question, what exactly drives stocks? Is it fundamentals, news, flows, positions, or future outlook?
All of the above, Brooke. And at different moments, at different times, at a different scale, let's dig into those four drivers. So fundamentals, that's earnings, margins, revenue, basically all the components that make up a company's balance sheet. And as an investor, you want to make sure that your balance sheets, that your fundamentals, whatever companies that you're invested in, that they are strong. Second is news. So this is the business that we're in. This is any surprise that investors need to reprice when it comes to risk or opportunity. Third, flows and positioning. So this is how investors are positioned heading into a particular event. So for example, if everyone is bullish, sometimes a reaction can fall a bit flat. And that's what we see with some of these tech names. Nvidia, for example, sometimes they have really strong earnings, but because the valuation is so high and people are very long on the stock, you get a bit of that muted reaction. And then finally, future outlook. You have to remember that the market is a discounting machine, always looking ahead to the future, 6 months out, 12 months out. It's all about those expectations. But I will say, Brooke, when it comes to the short-term reaction, that's usually due to positioning or a policy change, like we were talking about the Fed cutting interest rates.
Ali Canal with all your year-end questions answered. Thanks so much. That's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter. And stay tuned for Market Domination coming up next.